So I bought the property in a different entity. Like I made a new entity up just for that deal. I think I named it whatever the address was, LLC. And I bought it in that entity to protect my other assets in case the seller were to come after me. Because then if the seller came after big entity, the one that I own, that lender's loan is tied to that. Obviously, that didn't happen, knock on wood. But I thought there was a little more risk there. So I spent the money to set up an individual entity tied just to that property. So if the seller tried to sue my big business, they couldn't come after that. You know what I mean? So like you gotta, know that if you get into a deal that might be a little hairier, like with a seller liability, coming back after the fact, you got to make sure that investor's protected. And usually if you have a title insurance policy like that, that's all you really need.
Hey friends, welcome back to another episode of the Evergreen Marketing Podcast by Carrot.com. This is where we help you build a business of freedom and impact by dialing in your online marketing. But not today, got something a little bit different. So this is 100th time guest, Mr. Greg Helbeck. If you missed part one, go back, listen to it. Greg Helbeck, investor in some really competitive markets. He's done over 300 deals. And the last episode we had him on talking about sales negotiation. We talked about what's working as marketing, ton of gold nuggets in there. It was a really good episode. This time we're going to be talking about how to raise private money, the differences between private money, hard money, how to win people over so they'll actually lend to you. It's going to be good, but totally different topic. But Greg, welcome back, dude.
Thank you. Happy to be back on for the 6th time now.
Yeah, I think that makes it 6. So yeah, love talking to you, man. Before we get started, another quick icebreaker. I'm gonna put you on the spot. What's one of your favorite marketing tips for someone? I know we gave a bunch away in the last podcast.
My favorite marketing tip for someone,
or it could be like maybe a philosophy to marketing. I don't know.
Track everything you do. It's that simple. I'm serious, especially in real estate where the dollars are so high. If you just track, even if you're doing like minuscule stuff like door hangers or bandit signs, you want to be able to track everything you do so you know whether it's working or not. Because I see too many investors get hung up emotionally. They go out and they do something. They don't track it. They do it for a while. They complain. And then they come to me for help. And I'm like, well, how many leads? What happened here? And they're like, I don't know. I'm like, well, if you tracked it, I would have been able to look at your numbers and say, oh, you got a shitty response rate or, whatever. But they don't track it. And it's super easy to track it. You don't need some fancy tool. You could just use a Google Sheet. So you always want to track stuff when you're marketing, even if you're doing branding, like you're putting out branded postcards or you're, hanging, like whatever, just track what you're doing, have a different phone number on there. Billboards, some buddies of mine have like wrapped trucks and they put their cell phones on there. I'm like, bro, the eye doctor could be calling you and then the seller could be calling you. You have no way to tell the difference.
Yeah, absolutely. Get a tracking phone number. You can get a tracking link in your Carrot site super easily. Yep. Campaign tracking links, super easy. Turn it into a QR code.
Exactly. Here's one little other ninja hack I was saying. You got to take advantage of those Carrot UTM tracking links because like there's this little thing that I haven't done yet, but it seems to be interesting. Have you heard of the app called Nextdoor?
Nextdoor? No, I haven't.
It's like complaining Karens yapping about their coyotes in their backyard or whatever.
Okay. Yeah.
It's like a local, like, kind of like social network, like hyper local to your like neighborhood.
Okay.
And I was like, man, I bet you no one's advertising buying houses around here. And I bet you everyone knows their stinky neighbor's house or whatever. So I was like, maybe I'll run Nextdoor ads and I'll use that Carrot UTM tracker and embed that into the ad so I can track it.
Dude, try it out. Let us know how it goes.
Yeah, exactly. It's on my list of things to do.
Well, now there's motivation because nobody's heard of it until now when the podcast.
I know. I might have just revealed the next PPL.
Someone might beat you to it, man.
Yeah.
Oh my gosh, that's funny. Cool, man. Well, let's break it down, man. You've been in business over 10 years. You've been investing. You started out wholesaling. You got into flipping, rehabs. Now you're buying properties from wholesalers. So yeah, let's kind of talk about how to get private money, man. Talk to me about the difference between private money and hard money real quick. And then like why private money versus hard money and when.
Yeah, no, I'm glad you're starting with the hard money because I think if you're brand new, you don't want to get private money because you don't know what you're doing. And you can pretty much borrow money from anybody, for any terms, assuming you negotiate them. So hard money, the difference between that and private money, because a lot of hard money lenders call themselves private lenders. They're not. They're hard money shops. Hard money lenders are companies that intentionally lend to real estate investors, and they strictly loan on a loan to value basis. They're pretty much only concerned about the collateral, which in this case is the property, and it's their terms or the highway. They're going to have their terms. They're going to, okay, I'm going to loan you 80% of the purchase. I'm going to loan you 100% of the rehab. I'm going to only loan up to 70% of the ARV. It's always going to be monthly payments. You can never do balloon, and it's our company policy. Think about it as a bank for real estate investors, right? It's not like going to Chase, because then you're going to have to personally get underwritten. But these are professional real estate investing lending companies. They're most likely never going to loan you a true 100% loan to value, which I'll talk about. But some might say they'll do 100%, but when you take their fees into account, it's never the case, because it's always their terms. You're paying for their legal fees, like to close if it's in New York. You're paying points always, every time. You can never get around that, most likely. They're going to give you the construction money in arrears, which just means you're going to have to pay the contractor, and then the hard money guy's going to pay you back. You're never going to get all the money at once. And it's great, because it teaches you how to get good deals. Because if you get a deal under contract, you try to get a hard money lender to fund it, and he looks at the value and says it's not there, he's not going to give you the money, which is usually a good thing, because that means you're about to buy a shitty property.
Yeah.
So it's like it's like a stopgap for people. But the problem with hard money is that you always have to put money down, and that's fine if you have liquidity. Like, it's better than being in the bank. But if you're in my area where these houses are $500 to $1 million, 10% of 500 grand is 50,000. If you buy 10 properties, it's 500 grand of your own money you're going to have on the street. So you're always going to run into a cash constraint, because the hard money person is always going to only lend you most likely up to 90%. And even if it's 100%, you're going to be paying interest on 100% of the loan, and you're going to have monthly payments every month. So if you have a $500,000 loan at 10%, that's, I think, 50 grand a year divided by 12 is a monthly payment. You got 10 of those going on. I have a friend out here, his biggest flipper in town, $150,000, $200,000 a month of hard money payments that he pays, right? Monthly.
Sheesh.
Yeah. So he makes millions, but that's just the truth. So you're going to be in a position, if you start scaling your flipping business, which is harder to do, it's very hard to do that, but we can get into that. You're going to have a lot of cash going out the door in the streets, hundreds and thousands. It's serious. And I've been there, and it still happens sometimes. And then you're going to get the sales happen. You're going to get all your money back, and then you're going to put it right back out on the street. And you're always going to feel like you're on this freaking hamster wheel of cash, because with hard money lenders, they're only going to give you so much money. So private money, to compare it to the, thing we're going to talk about today, is when you loan, it's peer-to-peer lending, right? A lot of them will loan to your LLC, which you should be buying an LLC. But you're negotiating with an individual. You're negotiating with somebody's IRA. Maybe they have cash in the bank. Maybe they have, some sort of line of credit they can borrow against on another asset account. And you're able to dictate the terms of that note, which is what it is. It's a note IOU. It's a note agreement, and they're going to fund your deal. So sometimes they're going to want collateral, which in my case is a mortgage. Sometimes they'll give you an unsecured note, which just means it's a piece of paper that says Greg's borrowing money from Steve, and Greg's going to pay Steve back. There's no mortgage on the property. It's super flexible. You could pay them in balloons. I've been a hard money lender. When I did it, I took my payments on the back end. So I never even got any monthly payments. You can make it whatever the hell you want to make. You can negotiate the interest rate. You could pay a guy 8%. If he's getting 5 in the bank or whatever, you pay him 8, whatever. You could pay him 15%. It doesn't matter. You have all the flexibility, because it's a peer-to-peer loan where you both negotiate the terms that work for both of you.
Okay. Yeah, that makes sense. And so for you starting out, I don't know if you said this, I think we might have skipped over, but did you start with private money? With hard money? Start with hard money.
Yep.
Okay.
That's how I started. I saved enough money up to where I had enough, more than enough, for a down payment to do a flip project. This was a small Cosmo rehab. And I used my cash to get into the deal for the monthly payments and the down payment and the construction. And then when I sold the property, paid off the lender, I got my money back, and then I got my profit.
Okay. Nice, man. So who do you feel like makes a good fit for private money? And I don't mean who investors, who are you looking at to?
You're looking
who's most likely?
You're looking for people who have liquidity. And usually that money is invested either somewhere else, their business, an IRA account, like I said, a stock portfolio that they can collateralize, which just means, let's say the portfolio is worth 5 million, and they can get a line of credit against that portfolio, and it costs them 5%, and they're loaning out to you for 10%. They're making a 5% spread, basically arbitraging money. So people who have money, you can't raise private money from someone who has no money, because you're going to need their capital in order to invest. But it's people that you'd be surprised. people that you went to high school with that have been working for 20 years and they got, a big fat juicy, self-directed account. And they're like, yeah, man, I'm getting smoked right now in the market. Like, it's not that exciting. If you can give me 12%, like, that's something I'd be willing to entertain. So it's people who have, investment accounts or sometimes just cash, guys, like super rich guys, depending on where you live, they couple million in the bank and it's just sitting there, So if you can build a relationship with them, which is key, you could potentially get into a situation where they can start lending you their money.
Let's use the high school buddy as an example. How, maybe you haven't talked to him in 15 years.
Yeah.
How are you building trust and real credibility with these people? How long does it take?
Yeah.
What are you doing?
That's a huge, dude. That's the key is you don't want to chase people for money ever. You can message them, but you never like, hey man, I'm looking to like raise some capital for my next deal. Like, it's not like, you don't want to have it be that way. And then also there's, I'm not a lawyer, so this is not legal advice, but you can't necessarily publicly advertise securities online unless you have a fund. So like I see guys all the time posting like, I'll give you 12% on your money, invest with me. That's illegal unless they have a fund, which they usually don't. So you got to be careful on how you advertise this. So in terms of your high school friend, for example, let's say that he follows you on social media or she follows you on social media and you post about your properties and you're very vague with what you say. So for example, you're like, hey, if you're looking to be a capital partner or you're looking to get involved in our projects, reach out to me. We can have a conversation to see if maybe investing in real estate makes sense for you. You're very vague about it. It's not public. You're not promising returns, which is, like I said, if you don't have a fund, you can't do that legally. You get them to reach out to you. Oh yeah, I saw your post about, getting in real estate. I've always wanted to do real estate. I've always been so damn busy though. Oh, okay, cool. Well, this is what we do, with private money. And you explain to them the process and then they make the decision if they want to invest with you or not. And it's a very easy conversation. It's nothing crazy.
Walk me through a little bit of this conversation. What's that look like with the high school buddy?
I think I raised like four different private lenders last week. And it was from a social media post regarding, hey, if you want to get involved in our properties and you don't have the time or whatever, reach out, get on the phone with them. A lot of these people I have are like, I know them like through the grapevine. So
this is on like a Facebook business page, your personal.
Instagram, yeah, just like, but you're not selling a security. That's the, like, I want to be clear about that. Like, you're not offering interest rates on investments on property. That's a huge no-no with the SEC. You can't, and I used to do that back in the day and I was told to stop doing that. So, I'm just telling you what I've learned from experience. You have on the phone with them, you explain to them, first of all, I never want to get into a sales pitch with someone if I'm on the phone with them for 5 minutes. I want to, hey, how you doing, man? It's been a while since we spoke. What have you been up to? What have you been doing? Usually it's business talk. Hey, how's your job been? Whatever. How's your business going? And then, I like them to talk. I want to hear what's going on with them. What can I do to help them potentially? And then usually they're going to divert the conversation and say, hey, so what do you got going on? What's up with this real estate thing? How can I get involved in this? And then at that point, you have the opportunity to say, yeah, so what we do, we raise private money, the way that it works, and we could talk about like the nuts and bolts of it, is we borrow money from individuals. We pay them a very reasonable interest rate. Their investments protected by the property through a mortgage or a deed of trust, depending on your state. And it's a way where we've been able to help a lot of people get some pretty decent returns backed by real estate. And it's been a win-win. And then you just kind of shut up and then let them kind of keep asking you questions.
Nice. Okay. What are some of the most common questions you get from people that have from potential lenders that have never invested with you? What are they asking?
Yeah. So they want to know, how is my investment protected? Right. How am I protected here? Like, I know you've been around for a while, but how do I know you're not going to F me over? And, that's a simple question and it could be a very simple answer. Hey, I totally get where you're coming from. So there's a few things we do. Number one, and this is me at least, I only raise private money on deals that have a really good margin so I can protect the investor. So the loan to value, there's going to be a big gap. Generally, the most we'll borrow is like 70% loan to value, which means that no matter what, you have a first position mortgage on a property that has a ton of equity in it. So if something went wrong with the project, you would be able to, in theory, be able to foreclose and sell this thing and still get your money back plus a profit. So you want to sell them on the loan to value. Like, there's equity here. You're not getting over your skis. Number two, there's a mortgage, right? So if something happens to the operator, they have a mortgage that they can, or a deed of trust in Oregon or Washington. They have a security instrument, which is the first lien on the house, which means that for this thing to sell, this lender legally has to get paid. It's like a bank loan when you go buy your house, right?
Yeah.
So they have that, which is protection. And then the third thing is quite frankly, it's like, if the deal, well, you obviously want to work with someone that you trust, but if the deal doesn't work out, they have equity, like I said, and they have that mortgage on the property. and they're listed on the insurance policy as like if there's a fire or something, God forbid. They're listed on the title policy as an additional insured to title. So if there was a title claim, that investor is going to get paid out. So their investment is not guaranteed to be risk-free, because you can never sell investments and say you're risk-free. It's fraud, right? But it's generally protected by these certain measures. And then at the end of the day, it's a trust factor. Like I gave a guy two hard money loans or private money loans last year, and I knew him for a while. I knew that he was a good operator in Florida. And I said, listen, the collateral's decent. It's not a home run, but it's decent. I'll do these loans for you with my own funds. And I'm loaning to you because I know, like, and trust you, right? And that's how I am making this loan. And these are the terms I want. And it was 12 at 2, so 12% and 2 points, which were my terms. But I knew he was a stand-up guy and he was going to pay me back. And obviously I could have been wrong about that. Turns out I wasn't. He ended up paying me back. But I went off the trust. And I looked at the property. I made sure that it wasn't like a shit deal. And a lot of it is trust and having the ability to know that someone's going to be a good operator with your money.
Interesting. So how are you, what are some of the ways you're building trust with these lenders? Are you, getting fancy, going to Canva, making like a sheet for them, be like, here's my stuff?
Or so, I mean, there's a few things. There's trust in the property and there's trust in the operator. Like trust in the property is showing them the numbers. So like most of my lenders that I've been working with for a while, like I could just send them a property and be like, hey, like this is the house. This is what we're looking to raise. This is the plan. Do you want to fund it or not? Like, that's it. Like, or do you want to fund it? Is this something you can do? And they're like, yeah, sure. So once you have established relationships, you could just, it's easier to just get the deals done. But generally, if we're going off the numbers, here's the property address. Here is a full deck of pictures. Here's a video. Some guys want an appraisal if they're like brand new, like I've never worked with you. I want a third-party appraisal to make sure that you're not biased, which is fine, no problem. Here's what my plan is. My plan is to put this much money through this budget to sell it for this price. And once again, these are the comparables that's just going to justify the price. Assuming that all works out, even with some margin, margin of error, this is the profit potential, right? After paying you your interest rate. So there's clearly like a nice spread here where there's a good opportunity to flip this and make money. Or if you really want to get wild, you're like, listen, if I can't sell it for some reason, this is what the appraisal value is. I'll just refinance and I'll keep it as a rental. So like the more exit strategies you can show them too, like it just gives them more assurance that like their investment's even more protected. Cause like if someone's banking on a deal and it has to sell as a flip, well, if that doesn't work out for some reason, like assuming they're a good borrower, they'll pay them back regardless. But if you can also keep it as a rental, like, that's a double exit strategy. So now it's like even safer.
Yeah, which kind of goes along with what we were talking about in the first episode. We were talking about novations and like having multiple exit strategies. And it's like, well, you could get by just wholesaling, but it's going to be harder to get a lender if like that's your only way out.
Yes, exactly. So that's like the property assurance in terms of like, the trust factor. Like a lot of it is pre-existing relationships, people that you've known and networked with before. You're not just cold. You can cold call like private lenders because you can reverse engineer public records for this, which I've done.
Interesting.
Yeah, that's a whole nother rabbit hole, but you could do that. And because like these guys have literally made private, like you could literally see the mortgage on the line. Like, saw you gave that guy a loan, whatever, hey, you want to loan me money? You know, they're a lender, right? It's not like you're calling your cousin being like, I hope he's rich. And then another thing I want to say is besides signing a mortgage or a deed of trust, depending on your state, I mean, like I've borrowed money where like I've had to sign confessions of judgment that aren't recorded, which is just in plain English. It's a default judgment in the future that states if this lender doesn't get paid back, default judgment, like don't even go to court. So it's a protection mechanism for a lender where it's like, we're not going to record this, but in the event this deal goes south, you're going to sign this and then we could have it if we need it. You can sign personal guarantees, which, like I said, that when the borrower personally guarantees the loan, which means that even though they do the loan through their entity, if something goes south, this individual, exhibit A is on the hook. So that's another security that I made the guy that I loaned to sign a personal guarantee. And then the last thing you could do is you could do some sort of a performance deed or a quick claim, or not a quick claim, a deed in lieu, which means that if we're about to go to foreclosure for some reason, you are agreeing that you're going to deed me the house back with no foreclosure. That's what that means in like plain English. So there's all these different like other security instruments you can use to make the lenders feel more comfortable. But 9 out of 10 times it's you're selling yourself, you're selling trust, and you're, selling them the fact that, this is a reasonable person I should loan to and they're going to do the right thing by me, which I hope is the case.
Interesting. Do you have people asking about like how many deals you've done? Like
Yeah.
what
Oh
kind of
yeah.
properties
Yeah.
you've done? Like,
Yeah. You want to send them as much as you, I mean, if you're brand new, like I said, I wouldn't recommend this because you don't have any experience, but if you got
yeah,
50, 100, 200, here's addresses, here's the prices we paid for them, here's what we sold for them, here's what we made, here's a track record of winning, right?
you put that all together in like a deck or
Yeah, you
something?
throw it
You
on
see
a
what I'm saying?
deck.
Yeah.
I have a little slide deck I have where it's got addresses and numbers and what the
Mhm.
investor made and what we made. And I'm transparent with everything. I don't like, bullshit people. So I just show them the truth and numbers. Have I lost money on flips? Yes, but I've always paid the lenders back. Like that's the thing too. If you're a flipper, like I think I've lost money on like 2 flips and they were like just like barely break even loses or whatever. One was like 20K.
Yeah.
But like that's 20K after you're paying the lender back, right? Because that's a line item on the HUD. So it's like you could lose money as a flipper and that private lender could literally freaking make a killing. Right. So it's like you got to show these people that you're serious and you're not going to just like walk away from a loan or walk away from a deal when it's not in your favor just because it's not your money tied in the deal. That's how a lot of people get smoked is they overraise and then they don't care. Oh, I got all this money. If a deal goes south, you got a mortgage, you just take their house back. Like that's not how you play the game. That's not how you build a winning track record.
Yeah. Interesting. What's you have any horror stories of private lending? Any that went real south?
No. Like with me?
No. Yeah.
Knock on wood, no. Because the thing is, I take it so seriously. Like if I'm raising money from someone, I'm making sure it's a good deal. And I'm going to protect the shit out of the lender and I'm going to protect myself through the seller too. Like I'll give you an example. There's property I bought, private money. Seller was a little dicey. I was a little nervous about that, but the deal had a lot of meat on the bone. So I bought the property in a different entity. Like I made a new entity up just for that deal. I think I named it whatever the address was, LLC. And I bought it in that entity to protect my other assets in case the seller were to come after me. Because then if the seller came after big entity, the one that I own, that lender's loan is tied to that. Obviously, that didn't happen, knock on wood. But I thought there was a little more risk there. So I spent the money to set up an individual entity tied just to that property. So if the seller tried to sue my big business, they couldn't come after that. You know what I mean? So like you got to, know that if you get into a deal that might be a little hairier, like with a seller liability, coming back after the fact, you got to make sure that investor's protected. And usually if you have a title insurance policy like that, that's all you really need.
Yeah. Interesting, man. What kind of mistakes do you see newer investors making when they're trying to do private lending?
Well,
they're trying to get private
lenders.
Yeah,
they're online talking about percentage returns they can give people, which is, like I said, illegal. They don't know the business well enough, and they have knuckleheads who will loan them money, and they put trust in these people who don't have experience, and they'll go out and they'll lay an egg with that money, and they'll lose money, and then they'll be like, oh, or they don't have money too, like they're broke and they're raising money from someone else, and they have like $5,000 in the bank, and they have a $20,000 error, and there's a $15,000 delta, and they're stuck between a rock and a hard place. So I would tell you that if you have a lot of liquidity on hand, and you want to just use that for your, whatever, to just have operating capital, you're in a way more powerful position to raise private money, because you can be like, hey, if this thing goes south and I owe you $100,000, I got $800K in the bank, I'll cut you a check. Like, so if you have money, it's easier to get the lender on board because you have reserves to make up for any potential issues.
Yeah. Interesting.
Because if you have no money, like, what are you going to do? Like, you got no money in the bank. Like, you owe this guy $300,000. Like, what are you going to do? You got to borrow more money. You're going to rob Peter to pay Paul at that point. So, you got to be in a situation where you could take some blows as a flipper, and you don't want to raise more money than you're responsible with. And another mistake I see people do is they'll raise like 100% of the purchase, 100% of the rehab, 100% of the closing costs, which you could do if you're experienced and there's a loan to value there. But new people will buy a crappy deal and they'll borrow all the money from a lender, and then like they're levered out the gills. And now if that deal doesn't work perfectly, they're going to lose. But if you want to like work with a lender for the first time, like what I did, I didn't borrow 100%. I said, listen, I'll borrow 90% of the purchase price, just like a hard money guy would, but I'm not going to pay any points, and I'm going to pay you your money in balloons on the back, and a balloon payment on the back end. But I'm going to put down $40,000 to close, and the down payment, like the gap between what you're giving me, what I'm giving the seller, and the closing costs, and I'm paying cash for construction. So I'm going to have a ton of skin in the game. So you should, if you're working with a lender for the first time, you should be willing to put your own money into that deal to show them that you're not some, jackass. That's a big thing I think would help a lot more people. Because if you're not willing to put your own money in the deal, why would someone else?
Just trying to get in with zero skin in the game.
Yeah, like what like if you, when I gave the loan out, the 2 loans out, I didn't even ask him about that because I knew the guy for a while, but I could have probably been like, yo, I'll give you like 90% and like you fund the rest. But I was like, I just kind of sent it, which not a good idea. Worked out. But like, if you're borrowing private money, like you want to slowly but surely build your way up to where you have enough trust and credibility to where you can borrow 100% and actually know what you're doing.
Yeah. Yeah, that makes sense. Is there anyone you wouldn't use as a private lender? Like any family and friends, you'd be like, I'm just not going to risk that relationship.
I at this point I would, because I have the confidence and the liquidity myself to where I could pay them back. But no, I wouldn't probably. If someone like in my family wanted to loan me money, I would go even harder to protect that money too. Mm-hmm. So I think like sometimes even that's the case. Like obviously you treat everyone the same way, but like if your brother loans you money, like you don't want to lose anyone's money, but like if you lose your brother's money, now it's like it's going to be an awkward Thanksgiving. So I would be a little more careful with that, but I wouldn't be opposed to someone just, doing that if they know what they're doing. Because money is money at the end of the day. Like in terms of like, they're getting the same investment return the other person's going to get, and you just happen to be their brother.
Yeah. Interesting, man. Any other tactical things that you've done that have helped you raise private money?
Yeah. So like tactically, like what I'll do is I have it's like a CRM for private money lenders. It's not like an actual, it's like a Google spreadsheet where I have prospective lenders, committed lenders, how much they're committed for, proven lenders that I've worked with, what they're committed for. And it's like a giant pipeline. So I have like my main guys or girls. I have my new committed lenders who are down to lend, what they're down to lend for, the terms they want. And I have prospective lenders, like who am I still trying to, get in touch with and see if they'd ever want the opportunity. And then I have a scorecard of all the activities. So for example, activities could be how many, Facebook posts did you make regarding private money? How many, people did you reach out to in your network that, maybe reached out before, you never followed up with them? How many private lenders did you maybe cold call on the public record? Because like I said, you can find that information out. You could use a tool to find out who made private money loans. You can just hit them up. Like I saw your loan to WeBuyHouses.com, 300 grand. I'm in the market, you could, I'm not like against doing that from like a prospecting standpoint. Cause in that case, you're seeing that they're already doing the thing that you want to do. Mm-hmm. Like you're calling someone who's already like showed the public that they're loaning money.
Yeah.
So you can call them and it's like, it's all good. It's like you're calling a guy who loves steak, trying to sell him another steak. You're not.
Maybe you said that and I missed it. Where are you going to find these people? I didn't know that existed.
Dude, you could find it's all public information. I don't know like every county, but I know that like in my area in Washington.
Oh, just county records.
Yeah, you just go to the county clerk and you can look up the loan, but instead of that, it'll take like 10 years. You go to like PropStream or like any of these tools and list source you can do, and you can filter type of loan, purchase money mortgage, type of lender, individual, right? Purchase, like you could see, like you could just reverse engineer the data and it'll give you all the names and you can call them. So it's like someone's bought a house within the last 12 months. They've got a purchase money mortgage, which is like basically like a bridge loan. And the lender was an individual, right? Not an entity. Because a hard money company is going to loan like, 123 Main Street Capital Funding. But if like Bob Smith gave money to 123 Buys Houses, Bob Smith is the private lender. Like it's literally on the record. So then you take that information, you take the doc page, you pop it into your county clerk, and you could see in Lee Meyer, you could see the mortgage. This is what he gave. This is the node mortgage. This is the interest rate. This is the terms. This is the balloon. You can see it. And you call Bob up. And when he notarizes the mortgage, he's freaking got his address right there. You put him in Skip Trace. You call him up. Hey, Bob, how you doing? I'm calling because of X, Y, and Z. And you got to be confident with it, though. You can't call up and be like, hi, I saw you give a private money loan out, and I'm you're gonna be, what the fuck are you talking about? Like, especially in New York, you get laughed out of the house. So you can do all that too, but I wouldn't, if you're brand new, I wouldn't do it. Like do that when you have some experience, because like I said in the beginning, like when you have experience and you have projects and you've used hard money, which is a great tool. And I still use hard money sometimes. I still use it. I just bought a house over here, hard money loan, because I felt like there was some risk there. It was a hoarder house. Never bought a property in that town before. I could have raised the private money, no problem. But I'm like, you know what? I think there's more risk here. So I'm going to have the hard money lender fund most of it, but I'm going to put my own cash into this deal because I want to mitigate the risk as much as possible. So I tell all my private lenders, listen, if you're hearing from me, it's because it's a good property. Because if I think the deal is tight, and I do buy tight deals, I'm going to put my own money down in that property and have a hard money lender just fund a part of the purchase price because I want skin in the game because I want to take the risk. I don't want to put you in a situation, Mr. Lender, where you're taking all the risk and I'm hoping it works out. Like, and it's true. Like, that's what I'm doing. Like, I had a deal I made $20,000 in profit on a fix and flip. Tight deal. I could have raised that private money in 2 seconds, but I use it responsibly. I said, nope, hard money. I'll pay cash for everything else. I think I had to put like 80,000 into it of my own money. And, you know, I made 20 grand, which is terrible for a flip. So like, you have to be like very serious with your lenders on like, if you're going to borrow money from them, it's a good deal. Because once they trust you, you know, they'll give you whatever you like. They'll give you whatever you want. Like, oh, sure. Because they're getting the, 14% interest rate. They're like, when's the next one, man? Like, they're like, oh, you got to pay me off. Jesus, man. I would love this. These monthly checks are great. Oh my God. I made 15 grand last month. Like, so like they want to give you more money. So you got to take that seriously where like, because they want to give you money and you've worked with them, you don't want to take advantage of that situation and put their money into shitty deals.
Yeah. Yeah. Interesting.
As you can tell, I'm passionate about this.
Yeah. No, it's
very
good stuff,
passionate
man.
about this.
That's good. Is there anything you're doing? So you have like the slide decks you'll show to like potential new lenders. Is there anything you're doing online? You have like website or anything like that, or just keep it low tech?
Nah, low tech. But I don't do dog and pony shows. Like I don't do that. Like I send them slide decks and they can look at it at their own. Like half the guys don't even look at it. It's like I'm not gonna get someone on like a call. Like, this is us. This is that. Like at least the New York people I deal with, like they're savages. Like they're not interested in that. Like I'll send them the slide deck. If they want to look at it, they'll look at it. Sometimes they will at their own time. But I don't want to come across like I'm pitching somebody. Like I have an opportunity where you can make a good return, but it's got to make sense for both of us. Like if somebody wanted like, I'll do 85% interest. Like, like it's like a seller. Like, oh, your price is too high. I'm not interested. So it's like that lender, like it has to make sense for both of you. Like if you're happy with the rate and they're happy with everything else, like, it's almost like you're the person they should be chasing if you think about it.
Yeah.
Like that's how it is a lot of times. It's like, all right, like I got more money than deals. Like from a private money standpoint, like I could call 10 lenders up. Like what makes me want to call Bob instead of Steve? I'm just making this up. So, cause like, that's what happens. Like I have friends who like have tens and tens and tens of millions of dollars of private money. So like they have unlimited money to buy houses, like unlimited bunts. Like they make a text and it's done, fund it, like $1 million purchase done. So you get to that point. I'm not there yet, but, you have infinite money to buy as many deals as you want, but you have to be responsible with the deals you're buying. That's the key thing with private money. Because a lot of these guys, they're not going to do an appraisal. Some of them don't even care about the pictures. Like I want to send them everything myself because that's my process. But, you got to be very responsible with the resources you get.
Interesting. So at the risk of going off topic, I think it's really interesting how you're from New York, you're in Seattle, you've done business in multiple markets, you've done some stuff in Delaware.
We don't raise private money in Delaware either. That's another thing. We don't.
Oh, really? Why not?
We don't know. I don't know the market as well as I do New York and Seattle. I barely do. I have one guy here in Washington now, but like most of the time it's New York because I'm so freaking familiar with that area. I grew up there. I know the streets like the back of my hand. So I'm like, okay, I know what's going on here. Washington, I'd probably do it now. But Delaware, like we've always just done hard money there because it's a foreign market for me, who's the owner. And, could I raise money in Delaware? And is that something we're considering now? Yes. But it's got to really benefit that lender, and I take it so seriously, Brady. I really do.
Yeah. So I think it's really interesting. I've always been fascinated by like New York culture, that Northern attitude. There's a song, is it Noah Kagan, Northern Attitude? It's funny. Yeah. But like, it's a different culture. It's a different pace. It's a different, do you have to wear like multiple hats when you're talking to people? Do you find yourself switching between like, this is Washington me, this is New York?
No, I mean, I just the way I am. I mean, there's a lot of savages in Washington too, depending on where you live. It's a big hitting city, but Delaware is a lot different for sure. But New York, I just used to that. Like people are in your face, they're aggressive. Yeah. Everyone's got a lawyer up there. You know what I mean? That's just how I grew up and how I'm raised. And, I think it gives me an advantage, like, especially when I lived in California, like people are half asleep all day, and like they're stoned. And I'm just like, let me take that house right now. And like, other people call them back 3 hours later. So, I think it's just something I'm used to. And people up there, like the Northeast is just like a very like, aggressive, no BS kind of place. So it's just been my personality. That's just how I've always been.
Yeah. That's super interesting. Is Do you find yourself building relationships with people that have that type of attitude, or is it like turn off for some people?
No, I mean,
Doesn't
I
matter.
don't really like. There's people that are like way worse than me, in terms of like the aggression. But I don't. It doesn't really impact me. Like if I'm dealing with someone who's like really like sensitive and quiet, like I'm not gonna like I'm not gonna like turn into them, but I'm not gonna be like a dog. Like I'm gonna try to meet them in the middle. Be like, hey, like like I'm gonna talk in a calmer voice, but I'm not gonna do it to manipulate them. I just don't want them to be like, what's going on? This guy's a lunatic.
Yeah,
But it's
that's
just
funny.
like
I could hear you flip the switch.
yeah, it's just a different area up there, and that's the thing. Like everyone thinks they're getting scammed up there. Everyone has a lawyer. Like it's crazy up there. Like
That's interesting.
even the HOAs have lawyers, and they're all losers. HOA people. They all got cut from the JV basketball team, and they have a lawyer representing them. It's like, oh my god. So it's like you just get used to it. Like I see people like down south, and it's like sign a piece of paper, and it's like done, and I'm like, yeah, like that would that's great, but like it just shows how different the whole country is.
Yeah.
But yeah, it doesn't really, but I'm just so used to it, man. Like it's just, if you ever come out to New York, you'll be like, oh yeah, everyone's like this,
Yeah. It's super fascinating. I moved all over as a kid, like military child. And so we moved everywhere, big cities, small town.
You ever live up in the Northeast?
Right no, never in the Northeast. Closest I got was Michigan, but never in the Northeast. I've been to New York City, but yeah, I think it's refreshing. I kind of like the no filter, no BS, just like give it to me straight attitude. It's different. Like there's no beating around the bush.
I'll tell you this though, that's the general consensus, and that's most people, but there are clowns in New York. There's flounders, there's flakes, but it's a less passive aggressive place. Like I'll give you like California. I lived there for a while. It's a great place, right? It's got its issues, but it's a great place and it's beautiful. And the personalities there, it's just a different vibe. Like people are more passive aggressive. Like if they have a problem with you, like they still have a problem with you. They just won't tell you. In New York, if you're doing something stupid, they're gonna be like, yo, bro, what the bleep are you doing? This is BS. And, or like, wait, what's the deal? What do we got to do to make the deal? Like I was on the phone today with somebody out here flipping a property. And, like in New York, like when you're flipping houses, like there's a certain way you negotiate when the first day on market. And I told my agent, who's like a buddy of mine, I'm like, oh yeah, like that's what it came in at. I'm like, oh, bro, 10 over ask, we'll take it off the market right now, no issue. And he's like, what? And I'm like, that's New York style, bro. Like if they're coming in that hot and they're putting that much effort to trying to buy your deal right now, if we take it off the market now, what are we missing out on? Like it's been on the market for 12 hours. So if he wants me to take it off right now, 10 over ask, no contingent, like it's just a different place. That's just how I'm used to it. Like, I don't know.
Interesting. Yeah.
Gives me an advantage out here for sure.
Yeah, I was going to say, it sounds like it does give you an advantage. You move faster, make decisions faster. It's interesting, man.
Yep.
Anyways, I just had to ask. I was curious. I'm just fascinated by like all the different cultures in the U.S. It's fun.
Yeah.
Cool, man. Well, I want to bring it to a wrap here. I know that, we've been going for a little while. We've been recording, but
I changed my shirt in the first episodes.
You did. We've changed. I have not. This is my third podcast today.
Oh, man. You're maxed out.
Yeah, I'm maxed out, but this is a good talk. We'll have to have you back on later, man. Is there anything else you want to add? You feel like they'd be valuable for people?
Listen, with private money, I'm just telling you stuff that I've learned that I do. This isn't theory out of a book. This is all practical stuff that you can apply that I've applied. You got to take it seriously. You got to take people's money seriously, and you can't screw around with it. Like if you have the ability to raise a bunch of money, what do they say? It's Spider-Man. With great power comes great responsibility. So you need to be very serious about that. And you don't want to get too big for your britches and get over your skis and borrow too much money and then, put people's money at risk. Because, think about this. If you're not willing to put your money into a deal, if you're not that convinced on it yourself, why on earth would someone else take that risk? Just think about it that way. And then that'll make sure both your interests are aligned.
Yeah. I appreciate that, man. That's gold. That's gold. Well, everybody listening, thanks for listening. Thanks for tuning in. If you aren't subscribed to the podcast, go to carrot.com/podcast, subscribe. If you're not watching the YouTube channel, we'll get the full video version. You can check it out there as well. But if you enjoyed this, leave us a review, share with a friend. And if you have any questions for myself or Greg, like I mentioned in the last one, shoot me an email, brady@carrot.com. I'd love to chat. What kind of content do you want to hear more of? I'd love to talk with you. But thanks again, Greg, for hopping on, man. Thanks everyone for watching. We'll see you guys next time.